Okay, fun seekers, it is time to continue our long climb up the mountain, official investment gurus. Yes, we are going to continue fundamental analysis with financial statements and ratio analysis. Relax, relax, you accounting students. No, we're not going to do any accounting. We just use what the accountants do for us. I know some of you might still have nightmares of trial balances and journal entries and no. Don't relax. We just use the financial statements that the accountants do for us. Oh, we're so happy. Thankfully, we don't have to do that. In fact, if an accountant's spouse can't sleep at night, all he or she has to say is, "Dear, tell me about your day at work." It's a joke. Remember, we're going to insult everybody by the end of the semester. I took accounting a million years ago, and I did actually pretty darn good, but I did not enjoy it. And I thought, oh my goodness, I don't want to do this for a living. And I never have. So if you do want to do it, though, you'll be amply rewarded with work forever because there's never an end to the accountant's work. It just keeps getting worse and worse and more complicated. But what we're going to do is we're going to use the financial statements and we're going to use them to do some what is called ratio analysis. And it turns out that this is conceptually a whole lot easier than the discounted cash flow model, which even though the calculations were pretty simple, the words were strange and we're not really sure exactly what we were doing, but it's coming to you, right? It makes sense now. Well, you're going to find that the ratio analysis is pretty darn simple. You just take two numbers and divide one by the other and take a look at that number and compare it to compare the number of that company to its competitors and the industry they're in, the market as a whole. Yes, we'll go through this together. Okay? And so what you're going to want to have is, before we go, you're going to want to have this formula sheet here on the website. And then you can print out these. You don't have to, but I think it's good to have them. In the face-to-face class, we will pass them out. So if you're in the face-to-face class, will be in the chapter 5 packet. So make sure you have that formula sheet, and there's the assignment, there's the study guide, and then the balance sheet, income statement, and cash flow statement, or statement of cash flows. So let's continue with slide number 2. The 3 financial statements that every publicly traded company must submit to the Securities and Exchange Commission are the balance sheet, the income statement, and the cash flow statement, or sometimes called the statement of cash flows. The balance sheet is the snapshot of the assets and the liabilities of the corporation at a given time, usually every 3 months. The income statement is the movie. What was the income? What was the revenue that came in? And what were the expenses and how much is left over? What are the earnings? The statement of cash flows is a little tricky. It's a little interesting how it was created, because sometimes earnings aren't really earnings, and sometimes expenses aren't really expenses. What? We take accounting and we'll take a look at a very typical example, and that's called depreciation. But sometimes in the business, well, not sometimes, but in the Business 121 Principles of Money Management class, we use the term cash flow statement, and the accountants cringe when we do that. It's really the income statement. But for our Principles of Money Management class, it works just fine. We are looking at our cash flow, our income, and our expenses. The more we know and understand accounting, the better we will be able to understand and analyze the companies we are researching. But as we said, fortunately, folks, we don't have to perform any of the accounting. So relax, you accounting students. No trial balances. Yes. Okay. Slide number 3, the balance sheet. Very important. Why? Because it shows us the assets the company owns, and then the liabilities, the debts that are obligations of the company. And what's left over is called equity. That's what the accountants call it. We call it in the financial planning and money management class, the principles of money management, we call it net worth. But it's the same idea. And the formula is usually in the accounting world shown as assets equals liabilities plus equities. Most of us think of assets minus liabilities equals equity, but it doesn't matter. It's the same formula. And why do they do that? Well, because of the term balance sheet. Yeah, they used to be sheets on the paper. On the desk. They would tape all these paper sheets together and have assets on the left side, and then the liabilities and the equity on the right side. But of course, it's all electronic now. We don't do that anymore. But that's where the term came from, balance sheet. And the two must balance. The assets must be equal to the liabilities and the equities. Now, in the financial world, we tend to think of short term, intermediate term, and long term. That's not the way the accountants think. They lump everything into what are called current assets, which are assets that will be utilized within a year. Yeah. And then long term is anything more than a year. Okay, all right, that's how they do things. And so we have to, basically say, okay, we'll do that. Okay, we'll do it, accountants. And so current assets and long-term assets, whereas we separate short-term, a year or so, maybe 2, 3 years, intermediate term, 3 to 5 years, and long-term 5, 7, 10 years. So let's take a look at the balance sheet for Sprouts. You've heard of them, right? If you live here in Southern California. I'm not sure where else. I mean, I know there are other parts of the country. And so this is the Sprouts Farmers Market. I keep calling it Sprouts Family Market, but it's the Sprouts Farmers Market. And so we're showing the assets. Okay, there are the current assets. And we see we have cash and accounts receivable, inventory. You're probably too small if you're looking at this on your phone, so you want to print this thing out. And then we have the total current assets. And then we have the long-term assets, which are long-term investments, plant, property, equipment, goodwill. What's that? It's a little tricky. Don't worry about it. And then the total assets are 3.6 billion, because notice it says all numbers in thousands. This is as of December 31st, 2024. Whereas the liabilities, so that's the total assets. The liabilities, they break down into current liabilities, what things are going to be used within a year, short-term debt coming due, long-term debt coming due, other current liabilities, accounts payable, things that we have to pay, and then that's $679 million. And then they have long-term debt and other long-term negatives, long-term debts. And notice that's 2.3 billion. And then here's what's left over. The equity, what's left over in the company, that's what the company owns. And notice that the total stockholders' equity is 1.3 billion, and then the two must. It doesn't show. Well, it doesn't show total liability and total stockholders' equity. But if you add these two numbers up, sometimes they'll say total liabilities and equity, and they'll have the same number. And it's got to be the same as this, or it doesn't balance. It's got to be the same as the total assets. And of course, we can see it change through time. We can see that they have been, slowly building up their assets, slowly building up their actually quite smartly building up their total stockholders' equity, and their debt has been. If you go back a few years after this, and you can, you'll see that they took on a whole bunch of debt about 8 years ago or so, and have been obviously using it to their advantage, obviously, because they've been doing pretty darn good lately. So let's go back to the spreadsheet. I'm not sorry, the presentation. And that's the balance sheet example. The income statement, the balance sheet is the snapshot in time of assets minus liabilities, where the income statement is like a movie. It's showing you the money coming in, revenue, sales, they go by the same names. And then what are expenses, and the net income is what's left over. You hope it's positive, and usually it is if it's a company that's been doing very well. Okay, so let's take a look at the example. And so where is that puppy? Come on, sweetheart. Come on, honey. I talk nice to my computer. So here's the revenue, total sales, net, sometimes called annual sales. They call, by the way, you might have heard the term top line number when you were listening to the earnings call? Right. That's how much that's how much they sold. That's how much that was their sales, the top line number. And then we have to subtract how much it cost us because Sprouts doesn't. It's a supermarket. They don't grow their own food and they don't make their own diapers or anything. They buy that. And then we have gross profit. Then we have all the administrative, sales, general, and overhead, sales generate and operating expenses, sales generated general and administrative, SG&A, SG&O, and you heard that and people just said it without you, they just assumed you understood what they were talking about. But that's the salary, that's the rent, that's the all the other things they have to pay for, and a few others. And now they get down to total operating expenses, and so now they have operating income. So they took away the cost of the goods that they sold, the cost of the revenue. They took away the overhead. It's often called, or sometimes called burden. You might hear that term, burden, meaning the rent, the salaries, all the other things they have to pay, the utilities, and all that stuff. And then they were left with operating income of $504 million. Remember, it's all in thousands. Then they had to pay some interest. Notice their interest expense is really low. And that's why they loaded up on that debt, because they were paying like 1% on the debt or 2% on the debt. My goodness, they said, okay, let's load up on debt. And then there's their income before taxes, and then they had to pay income taxes to the government. And so now there's their net income from continuing expenses. And then these non-recurring events are usually blank for some companies. They might be more, some companies might have more of these non-recurring events. But Sprouts is a pretty straightforward business. It's a grocery store, so they don't have them. So here's the bottom line. So after everything was said and done, they brought in $7.7 billion, paid $4.8 billion in cost of goods sold, paid $2.4 billion in overhead, and then paid some taxes, $126 million in taxes. And that's what they left over. They were left over with $380 million in net revenue or net income or net profit. So I'm sorry, not net revenue. Scratch that one. Net profit, net income, the bottom line. So the top line number, the bottom line number. Cool. Okay, so back to the presentation. Come on, sweet. Where are you? There you are. And so that now here's the strange thing. And if you've taken accounting, you know what I'm talking about. Some of the income and the expenses are not always received for or paid in cash. Well, yeah, there's some, especially the one we're going to discuss, and we're not going to go any further than that, is depreciation. In the case of, well, actually also capital expenditures. In the case of depreciation, you don't write a check to depreciation. When you buy something big like a factory, or even things like computers and the like, you don't usually get to write the whole expense off in 1 year. You have to amortize it, which means a fancy word for stretch it out over years. And that's called depreciation. So you did not get to deduct the cost of the, let's say it's a factory that you bought for $1 billion. You don't get to deduct that the whole year in 1 year. Boom. You don't say, okay, I paid $1 billion this year, even though you did. No, what you have to do is you have to depreciate that over many years. But you don't write a check to depreciation. It's just an accounting entry which reduces your income. It's an expense that you didn't write a check to, you didn't pay for. You paid for it up front. And so that is why there's this cash flow statement. Because the cash flow statement is, what it does is then it goes, okay, what happened to your checkbook? Yeah, we know you're reporting $380 million in income, net income, but really, how much cash came through the door? And so that's what the statement of cash flows is. Because when you make a huge capital expenditure, you can't expense it the whole year. And when you take deductions for depreciation, you didn't actually write a check for that. That money didn't leave the checkbook. So that's what the statement of cash flows is. And it's a little tricky. And again, more you know about accounting, the more you'll say, oh, okay, I know what's going on here. So let's go to the cash flow statement of cash flows. And notice that it starts where the income statement ended. Sprouts made $380 million of income, net income. Okay, that's where we start. And then notice the first thing they do is they add back in the depreciation, because they really did not write a check for $274 million to depreciation. They had already spent all those capital expenditures years before for whatever, opening new stores, and probably mostly just opening new stores because that's their biggest expenses. And so then there's a few other accounting maneuvers in here. And here's a capital expenditure. See, they paid $230 million in capital expenditures, but they could not expense that. So that brought down their checkbook, but they couldn't bring down their taxes, their taxable income. So that's what's going on here. And then at the bottom, we see what happened to their checkbook. They made $380 million, but their cash only went up by $63 million. And you see that their cash flow here is kind of wonky here. They a few years ago, boy, did they rake in that dough. But notice that they've been making purchasing their stock and making pretty big capital expenditures, which you don't get the expense. So it's, hey, we made $380 million, but your checkbook only went up $63 million. But that's okay, because they're investing in themselves and they're buying back their shares, and so and paying out dividends. And so they don't pay dividends. They don't pay dividends. So yeah, that's what we. So we want to know more about that checkbook. We want to know about what's the cash flow actually? Okay, you said you made this much, but how much cash actually came in the door? That's what the statement of cash flows tells us. Okay, so let's go back to the presentation. Come on. Okay, there you are. Okay, let's continue now. All right, now, where do we get this? There are many sources. Of course, the most reliable source is the company itself. And that's all on what's called EDGAR. And I forget what EDGAR stands for, but it's every quarter, the companies must report to the Securities and Exchange Commission in their annual reports, the 10Ks, and the quarterly updates, the 10Qs, which I already told you about. 10Q, thank you, you're welcome. And so, and that's what you were doing when you were, maybe you didn't know it, but you were listening or reading or whatever, what was going on in the 10K or the 10Q from the CEO or the CFO and when they did their earnings call. And of course, everyone can get it. Everyone can just go online, boom, and download them. And of course, you can go to some of the other websites, and they different websites use different ways of reporting the data, so you have to be careful. But the more you learn about accounting, the easier this is going to be. A little bit of history here. Before the internet, companies would have meetings with analysts on Wall Street, and they'd often tell things that weren't yet public yet in their 10Ks and their 10Qs. So the SEC said, no, we got to fix this. And so that's what the earnings calls are about. Regulation Fair Disclosure said no. Everybody in the world must be given the information at the exact same time. And of course, the internet technology made it pretty easy, because they schedule an earnings call for, an hour before the market opens, or 8:30 in the morning, or 4 o'clock, 4:30 in the afternoon, usually not during market hours. And everybody, boom, the information is sent out to everyone using EDGAR, and then you can listen to the CEO and the CFO tell you what they think is going on with the company. And that's what you did in Chapter 3. Now, if you dig around, you'll find sources that are throwing around what are called the whisper numbers. What's the whisper number? Wow, we think Amazon's going to make this much money in this quarter. Well, fine. Should you play that game? Should you pay attention? In my humble opinion, no. Just don't. I mean, you're long-term investors. You're not short-term investors. Many investors opine that nowadays there is simply too much information. And there's this wonderful book by Nick Murray, which you probably won't read, but that's okay. he has a wonderful saying called wisdom sold separately, which is actually pretty cool. Wisdom sold separately. And as we said, don't play the whisper number game. Just, think long term. But still, make sure you sit in on the earnings call and see what the company's saying about the next quarter, next year, 5 years down the line is more of what I'm more interested in. Slide number 7. Now, we're going to start financial ratio analysis. We've already done a few, and in fact, we're going to review some of the ones that we've looked at and see some new ones. And then we're going to actually calculate them. Some of them, actually many of them, you just look up. You just go look up and they calculate it for you. Others you have to dig deeply, and it's not hard. Once you do a few, okay, I can do this. And that's why in the assignment, even though there's 27 of them or something, I ask you just do 12. Just do 12. I mean, if you want to do them all, fine. You don't have to, but make sure you do a couple of each out of each of the categories. Don't do all the first category because that's the ones that they usually give you. We want you to do some calculations. The financial ratios are the relation between two financial quantities expressed as the quotient of one divided by the other. That's the definition of a ratio. And ratio analysis is the study of the relationships between financial statements. Now, what we want to say beforehand, and we're going to come back to you and make sure that you listen to us, is that there is no one ratio that can accurately sum up the overall general state of a company. Every ratio must be considered in the context of all the information that you've researched. Plus, you must consider any ratio in the context of the industry the company exists within, and of course their competitors. And we're going to see a wonderful example soon. But really, folks, don't think, oh, look at this PE, I'm going to buy this stock. Or look at that PE, I'm not going to buy it. No, it's just one. Oh, I like to think of them as unlike the dividend discount model, which said, yeah, okay, let's continue this, or no, let's not continue this, or maybe we just have to, reassess what kind of return we think we're going to get from this company. It's more of a yes, no, continue, not continue decision. Whereas the financial ratios, I like to think of a stew. I like to think of a guisado, right? A caldo, like a big soup. That all these things are together, and there's maybe one or two that are screaming like, oh, you got something investigation to do, but most of them you just look at them as a whole. Try to look at them as a whole, and some are more important than others, but not too much, in my humble opinion. So let's go take a look at the common stock ratios. And some of these we've also called market ratios, although I usually hear common stock ratios. Some of these we've already gone through, like earnings per share and price to earnings ratio, dividends per share, dividend yield. So we're going to burn through these fairly quickly, okay? Because again, most of these you can just look up. These financial ratios convert key information about a firm to a per share basis. So in other words, we saw the total earnings for Sprouts Farmers Market, but what is it on a per share basis? Earnings per share. What's the price to earnings ratio? What are investors' expectations of the future for the company? And then we haven't taken a look at this PEG ratio, but we're going to look at it in a bit. It relates the price to earnings ratio to the growth of the company. Dividends per share, dividend yield, dividend payout ratio, we discussed those in Chapter 3. The book value per share, we discussed those. And then what's the company worth on the books? The accountants say it's worth, but of course the market value is usually a whole lot more. And then just like the price to earnings ratio, there's price to book value, price to cash flow, and price to sales. And these ratios usually use data from the balance sheet or the income statement, or both. Not usually, the S of do, right? They use the data from the balance sheet or the income statement, or both. They're not using data from some other place. Slide number 9, earnings per share. So this is review. We take the net income that we saw, the bottom line on the income statement, and we divide that by the number of shares outstanding. And we don't usually have to do it because it's done for us and we see it on every financial website. Earnings per share is the amount of annual earnings available to common stockholders, as stated on a per share basis. So we can think of each share like a little factory, like a little business entity in and of itself, earning 50 cents, 50 cents or 75 cents a share. It's the subject of much discussion and speculation, especially with regard to companies that are growing their earnings. Watch out for the whisper number. Earnings per share is subsequently used in combination with the current market price to compute the most important and, of course, most watched stock market statistic, the price to earnings ratio. So that was very simple, right? Take the net income divided by the number of shares outstanding. The price to earnings ratio is the most popular stock market statistic. We take the price of the stock divided by the earnings per share. And again, if you do the calculations, don't leave the dollar sign, don't put a percent sign. But if you do, nobody cares, right? Okay, but just don't do it because it's unitless. Historically, PE ratios were in the 5 to 12 range for mature companies, 14 to 20 for growing companies, and greater than 20 was only for companies that were really, knocking it out the park. But today, oh my goodness, it's commonplace. The PE ratio. Now, I should take this line out. Peter Lynch, talks about this, so who am I going to argue with him? But sometimes people say, well, why is that important? I say, well, it just gives you an idea of how long it's going to take for the company to earn their earnings back. The PE ratio also tells you how long it will take in years, assuming no change in earnings. And of course, the earnings are changing every year, and the price is changing, for the company to earn back its price. A PE of 3 will take 3 years. A PE of 20 will take 20 years. Okay, if that makes sense to you, if it means anything, keep it. If not, throw it away because it's not that important. But anything that Peter Lynch says, I think I should relate to you because he was one of the best investors the world's ever seen. Slide number 11. So here are 6 companies in very. I screwed up. This guy should. I didn't do the animation correctly. You'll see that in a bit. My apologies. I have to fix that. Shell Oil, right? Google, Biogen, which is a biotech company. Bank of America, General Mills. They make Cheerios and Wheaties. And Pfizer, which is a drug company, right? And so you say, well, obviously Google has a higher PE, but General Mills is kind of low, and the rest are 15, 16, 14. That's about right. But what's the problem here? These companies are in very, very different industries. So what we need to do is we need to look at their competitors. So look at the oil companies. We see that, ConocoPhillips, people are not as excited as Shell, Exxon, and Chevron. A little bit more excitement for Chevron, but what's going on with BP? 137? And that's why we put a little exclamation point there. It doesn't mean we shouldn't buy the company. It doesn't mean we should buy the company. It's like a little red flag saying, ooh, you got some research to do. How come British Petroleum's PE is so different than the others in its industry? Does that make sense? I think so. Usually it's some kind of anomaly. It's like, oh yeah, it's because this quarter they had a really bad earnings. Because remember, you math fans, the denominator. If the denominator falls rapidly, the PE is going to skyrocket. Right? As the denominator gets closer and closer to 0, the quotient explodes. So there might have been some strange thing going on, but don't worry. Next quarter, it's gonna go better. And that's often what happens. Or maybe it really is something serious and we want to stay away from BP. I don't think British Petroleum is going anywhere. Do you know they own Arco, right? Biogen is 15, respectable. Illumina, only 13. Who are they? Amgen, 25. And AbbVie, over 100. Again, that was the one that was I have to fix. Yeah. Is AbbVie really growing that fast? What's going on here? Well, it means we have more work to do. We have to because it's actually a very good company, folks. Don't get me wrong. I'm not trying to disparage them, But a P of 100, what's going on? Well, maybe there's something going on that we need to research, or maybe we just say, oh, we're not even interested. Let's go somewhere else. Here are the food companies. Not too exciting, huh? Hormel, these are the people who make spam. Pretty low. And Kraft Heinz, what's NA mean? Well, it means their earnings are negative. So instead of doing the calculation and putting a negative number there, we just see NA. Or I like Value Line puts no meaningful value, no meaningful figure. Yeah, NMF, NA, not applicable because they're losing money. And then here we see that the tech companies, pretty exciting, but not like they used to be, except for Apple and Nvidia, which was actually higher, but their earnings have been just screamingly going. So their earnings are getting bigger, so the denominator gets bigger, and that makes the quotient get smaller. So, yeah, maybe it's a good time to look at these companies, right? Because they're doing well, right? That's why we saw that, but their valuations are insane. You have $3 billion for Apple and Nvidia and Microsoft. My goodness. But they're global competitors. What about the banks? Yeah, banks are boring. U.S. Bank not as exciting as the other three, but still, banks are boring. They're supposed to be boring. When they get exciting, that's when we need to worry because they're probably ready to screw up the economy. But so check out the banks. They pay reliable dividends, and how do you know a bank is making money? Their doors are open. Now, what about the drug companies? Oh, they're all over the map. So far, Pfizer and Merck, pretty respectable, and Bristol Myers a little higher, but what's going on with Eli Lilly? I don't know. That's another one of those little red flags saying, ooh, investigate me. Why is Eli Lilly doing so well? Why are investors, I shouldn't say doing so well, I should say, why are investors so excited about the prospects for Eli Lilly? Do they have a blockbuster drug that is everyone's excited about? Maybe yes. I won't spoil it. I bet you know what drug I'm talking about. But you look it up. You look it up. Yeah, and they've been doing very well with this particular drug. So check them out. So you see the idea? We must always look at their competitors and see what's going on in the industry they're in and the competitors. And we're going to come back to that theme over and over again in this chapter. Slide 12. How can we account for the wide price-to-earnings disparity between different industries and different companies within industries? And again, it's the expectation of future earnings and possible dividend growth by investors. It's all about the future. Now, if you're looking at this on your phone, you're probably not going to read this, but this is from a wonderful book that you should read. It's one of your first books you read after the textbook, or One Up on Wall Street by Peter Lynch, or A Random Walk Down Wall Street by Professor Burton Malkiel. And he says, this is from Jack Dreyfus, actually. The quote is from Jack Dreyfus originally, who started the Dreyfus Funds, but it's in the book. Take a nice little company that's been making shoelaces for 40 years and sells at a respectable 6 times earnings ratio. Change the name from Shoelaces Incorporated to Electronics and Silicon Firth Burners. In today's markets, the words electronics and silicon are worth 15 times earnings. However, the real play comes from the word Firth Burners, which nobody understands. A word that no one understands entitles you to double your score. Therefore, we have 6 times earnings for the shoelace business, 15 earnings for the electronics and silicon, or a total of 21 earnings. Multiply this times 2 for the Firth Burners, and now you have a score of 42 times earnings for the new company. It's a joke, right? Because, this was the 1960s when silicon was the big thing. Now it's what? Right? Cryptocurrencies, artificial intelligence, meme stocks, NFTs. Yeah. So the technology changes, but the hype and the hyperbole and everybody gets excited and drives the price up. So the PE goes to nosebleed sections. And then there's usually a crash. And and some people are finally saying it. I think I didn't read the article, but I saw a headline where Bezos of Amazon famous, and yeah, we're in the middle of a artificial intelligence bubble, but somebody's going to win. Well, yeah, thank you very much. We know that. It's like we knew that during the internet. We knew, yeah, somebody was going to win. We just didn't know who, and that's who turned out it was Google, instead of Yahoo and Lycos and Dogpile and Ask Jeeves and Go, and yeah, amazing. You don't know any of those companies. That's okay. Slide number 13. So here's the price to earnings to growth ratio. And you'll hear people talk about this a little bit. And all it does is it takes the PE that we just saw and divides it by the growth rate. So the idea is that the PEG ratio should be around 1, meaning that the PE, the price to earnings ratio, should be equal to the growth rate. And if you have a PE about 20 and a growth rate of 20%, then that's about 1. Anything above 1 means that the PE ratio is higher than the growth rate. And now greater than 1 is common because people are willing to bid up the price for any kind of growth. Growth is where it's at. So check out the PEG ratio of some of the companies you're interested in. Most of the places like Yahoo and Morningstar will show them. And of course, you know how to calculate it now. Take the PE ratio, take the projected growth rate, and of course, we're talking about the future. We don't know if it's going to continue to grow at that rate, but of course, look at value line too. I like value line. And then dividends per share. This is again review. We take the annual dividends paid by the stockholders divided by the number of shares outstanding. And as we discussed in the 1980s, 1990s, dividends were, you don't want dividends. You want capital gains. And then 2000 and 2002, many investors changed their minds about dividends. Dividends can be discussed in polite company now, in my humble opinion. I'm a big fan of dividends. Dividends don't lie. So we want to take a look at how much dividends we're getting from our stock and then calculate on slide 15 the dividend yield, or just look it up. Dividends per share divided by the market price. This important statistic allows an investor to compare a company to other forms of investments that pay income such as savings accounts or bonds. Traditionally, 4 to 6% was considered good. This was often more than what bonds were paying. But currently, in October of 2025, it is now yielding 1.166%. The last time it was this low it wasn't there. We weren't there yet, but we're not there yet. We hit 1% in March of 2000. March of 2000. That was the peak of the internet bubble. Y2K was a new century, even though technically the century doesn't start until 2001. Whatever. Yeah, and so we hit 1%, and then the market S&P lost 50% almost over the next 2.5 years, and the NASDAQ lost 80%. So many people are saying, stocks are really expensive, and I agree, but it's not all the stocks that are really expensive. It's just a few of the really high yielding, not high yielding, but high growing. The ones, the Magnificent Seven, whatever you want to call them, the FANGs, whatever you want to call them, the top 10, top 11 companies in the S&P 500. Bonds are back to where 4.1% for the 10-year Treasury. That's pretty respectable. The Federal Reserve Bank drove up short-term interest rates in 2022 and 2023 to combat inflation. They started lowering in 2024, and then along comes the Agent Orange Mussolini, who's putting in these tariffs that so far haven't hit us as hard as they could have or will, because many companies are holding off raising prices. So the Fed's really worried about inflation, ticking back up again, but at the same time, the job market is weakening, so they've lowered the interest rate 0.25% just recently. And if it hadn't been for Trump, they would have been lowering it more, but they're really worried about that. I don't blame them. They're in a very difficult place right now. So remember, their task, they have a dual mandate, they call it. Full employment, keep everybody employed, make sure the economy's producing it and consuming everything it can produce and consume. And at the same time, don't let inflation get out of hand, which is these two things are diametrically opposed. And so they're a real difficult spot. So stay tuned. Slide 16, the dividend payout ratio, which we calculated back in chapter 3, very simple. Take your dividends per share and divide it by your earnings per share. And as we said, most mature companies often pay out almost all their earnings in the form of dividends. Why? Because they don't need the money now. How many times can you rewrite Word, Microsoft? Every time they rewrite it, they always make it worse, in my humble opinion. And utilities, utilities are growing now because of the need for more electricity from the large language models, the artificial intelligence. Growing companies retain their earnings, you accountants, it's called retained earnings, to support the growth of the company. So we love dividends. So watch that dividend payout ratio. Now, the book value per share, again, another statistic that we can look up. We don't have to calculate it, but it's very simple. Take the equity off the balance sheet, divide by the number of shares. It tells an investor how much assets are behind each share of stock. In other words, if all the assets of the company were liquidated, how much would each shareholder receive? It is common for the actual market price of a share to be above the book value since the company is worth more than if it were dissolved. And we saw the book values of some companies like Walmart and Costco and who else? AT&T and the like. And we saw that, the book value is far lower because it just makes sense. The company intact is worth more than if you just ripped it apart. Now, sometimes companies are in danger, and the assets on the books might be more than the market price. And in that case, it's a very dangerous situation for that company because then you have these people called corporate raiders, private equity, takeover artists, and if they feel that they could swoop in, take over the company, sell off all the assets, pay off all the debts, and walk away with money in their pocket, they're going to do it. That's capitalism, folks. Now, would you be happy about that if you had worked for this company for 22 years and now they're gone? You would not be happy. So you would complain to your Congress bozo and scream and holler, and they'd say, well, this is what we want. This is capitalism. That company was failing. That capital, not only the assets, but also you, the workers, were not being utilized to the best of their abilities. And so we want that company to be plowed under and a new company to take its place and you to find another job. And that's why we have unemployment insurance, folks. Don't let anybody tell you we have unemployment insurance so that people don't have to work. We can pay them not to work. No, we want them to find another job. And in the meantime, here's the insurance to help you get through that time. Make sense? Be careful. People love to spin conspiracies about things that we've been using for decades, and they're not perfect. I'm sure there's some people who game the system, but hey, it's there, and it's for the most part works pretty well. Capitalism, as we said, might be the worst possible economic system ever devised by man and women, except for all the others. So yeah. We do the best to make it the best it can be for everyone involved. Slide, I know it sounds like an advertisement, doesn't it? My apologies. Slide number 18. Now, okay, we had price to earnings ratio, right? Well, we are going to have the same thing. We're going to now take the price and take a look at it in relationship to the book value. And given that the book value per share is often less than the market price, the price to book value per share tells an investor how far above the book value the market price is. If the price to book value per share were equal to 1, that would mean they were the same. And that would be a very dangerous, as we said, position because they might be in danger of being ripped apart by corporate raiders. It's usually 3 to 6 or sometimes much higher. So check out the price to book value per share. And you usually don't see this reported. You usually just have to calculate it, but you can do it in your head. You look at the price, you look at the book value. Maybe the price is 220 and the book value is like 50. You go, oh my goodness, it's like 6 times more. No, not like 4.5 times more. So that's the price to book value. We're going to do the same thing with price to cash flow ratio. The current price divided by the cash flow per share. And as we said, cash flow often differs from the earnings per share for several reasons, but the most common reason is the depreciation. And we saw capital expenditures and the like. But there are many reasons. And you will hear people say, oh, well, those are good quality earnings, or those are poor quality earnings. And you go, what are you talking about? Well, during the internet mania, many companies were reporting record earnings. At the same time, their cash flow was negative. Now, wait a minute. That doesn't make any sense. You're telling me you're making record earnings and your checkbook balance is going down? How could that be? Well, capital expenditures, right? And also, some situations, such as what happened to the company that used to be called Western Electric. What's it now called? It starts with an L. Oh my goodness, I'm losing it. Hang on a minute. Just hold on a minute. I'm having a panic attack. Is it Laetril? No, that Laetril's it's a supplement. Hang on a minute. Lucent Technologies. Of course I know it's going to come to me. Lucent Technologies. They were the people that developed the transistor, folks. And if you use Linux or Unix, they were the people who developed that. And they developed a whole bunch of other stuff. And they made the best telephone equipment in the world. And they were spun off from AT&T. And they were, going to make it in the internet age. And they were selling tons of equipment to all these startup companies, all these telecommunications startups companies. But these telecommunications startup companies, they didn't have any cash. And they certainly couldn't go to a bank or sell bonds to buy this equipment. So what they did is they went to Lucent Technologies and they said, hey, Lucent Technologies, we want to buy $1 billion of equipment. Will you sell it to us? And Lucent said, well, sure, we'd love to. Oh, by the way, do you mind being our bank? We'll pay you $50 million for a year for the next 20 years. And Lucent foolishly said, sure. It sounds like a great deal to us. Remember, it's new technologies, productivity gains as far as the eye can see, and then the internet bubble bursts, and Lucent Technologies gets their equipment back, but it's already 2 years old, so it's obsolete. And now Lucent is in a ton of trouble because they have this equipment they can't sell, and they're not bringing any cash in, and they almost went bankrupt. But they survived the internet bubble, and they still build the best telephone equipment in the world, in my humble opinion. So check out Lucent Technologies. Okay, so that was poor quality earnings. And then lastly, price to sales. We do the same thing. We take the market price and divide it by the annual sales per share. So again, during the internet mania, many analysts use price to sales instead of price to earnings, since many of these new high-flying technology companies never generated any earnings. Are you with me? Understand? So I like PE. I like price to cash flow. I'm not a big fan of price to sales. So do be careful. But again, they're just one statistic. Each one is just a simple statistic that you compare to your competitors. And these common stock ratios, these market ratios, many of them you just look up. In our next presentation, we will then start doing some calculations. So get your cash flow statement, your income statement and your balance sheet, and the formula sheet, and get your calculator and be ready to do some calculations. And as you're going to see, once you've done a few calculations, 3 or 4, the rest are pretty darn straightforward. Okay. Thank you so much again for being in our class. We hope you're getting an education. We are so proud of you. You are now official investment gurus. Oh, you should be so proud of yourself. I know your friends and family and colleagues at work are proud of you. Everyone at Southwestern is proud of you. I'm proud of you. And you should be proud of yourself. See you at our next presentation, where we continue with the other financial ratios that we will analyze.